will today speak about different US tax topics related to sale of goods and sale of products to US market, but also having some company or organizational unit in the US. And I'm glad that with me we have today Gillian Symes and Gabriel Soto from EY US Tax Desk from London. And we have also external guests, Christian Kõrgma as Senior Financial Controller of FERIF and Alvar Soosar as Director of US Investment and Trade in Estonian Ministry of Foreign Affairs. And we would like to share with you some experiences, some knowledge, and I hope that this will be like good general understanding what you should think about if you think about the expansion to US markets. And we will start with US tax topics, then I will also comment a little bit some Estonian aspects, and then we will hear some experience stories. So enjoy the webinar and ask your questions in the chat if you have any. Thank you. And Gillian, please take the floor.
Excellent. Thank you very much, Rano, and thank you everybody for dialing in as well. So just some brief introductions before we hop into our agenda today. So I'm Gillian Symes. I'm an executive director. I'm trained in the US, but I'm based in EY's US Tax Desk, located in the London office. I've been in the London office my entire career, almost 15 years now, and I provide US international corporate tax advice. So although I provide US tax advice, I never work with US companies. I work with European, UK, and particular Estonian companies. And one of my areas of expertise is Estonian and European companies that are expanding into the US market and how to sort of set up that cross-border arrangement. I've worked with Estonian clients for a number of years. I think it was back in 2019 that Rano invited me to Estonia, and we actually did a session like this live. So hopefully the next time we're talking like this, it's also live again. So I'm also joined by my colleague Gabe, and I'll let him introduce himself.
Hi everyone, my name is Gabriel Soto. I'm on the US Tax Desk in EY's London office, and I'm on the US Tax Desk focusing primarily on US state and local tax. So any kind of tax at the state, the city, the county, local jurisdiction level, so there's a myriad of taxes that can encompass that we will get into in some detail. I've been with the firm for about 12 years, focusing during that entire time on US state and local taxes. Spent most of my career with EY in the US, and now I'm here in the London office helping European companies that are interested in doing business in the US and needing to navigate the state and local tax landscape.
Excellent. Thank you very much, Gabe. And I'm not afraid to admit that Gabe has a trickier job than me dealing with state and local taxes. Excellent. So how about we walk through the agenda? What are we going to talk about today? Can we flip the slide? Great. So the way we've set this up is we've thought about an Estonian company at sort of its early days when it's just operating in Estonia, and what's sort of a very natural course of events into expanding into the US market. So the first agenda item is going to be remote sales, largely focused on Gabe. Gabe's going to talk about state sales taxes. This is where you're sat in Estonia, you don't have a physical presence in the US, but you're selling either your products or licensing software or something like that to customers based in the US. Next, we're going to talk about, okay, if you want to set up a US office, what should that look like? What should your operating model look like? How should your US company interact with your Estonian parent company? And what are the different alternatives there? We're going to talk about managing the taxable presence risk, both from a federal and state perspective for your Estonian headquarters. Gabe's going to cover state and local taxes, just some other tax considerations you might not have thought about. Rano's going to talk about Estonian tax, and then we're joined by two very fantastic guests who are going to give us more of a corporate overlay and talk about their experiences, Chris and Alvar from industry. Excellent. So what's sort of the typical life cycle? What we've tried to illustrate on this page is what are those types of things? What are the questions you should be asking yourself as you're expanding and growing that presence in the US? Because what I oftentimes find is a lot of the companies I work with don't know what they don't know. Right? So these are just the big questions you should be asking yourself and you should be thinking about, especially if we've got anybody on the call today who's maybe perhaps got a fixed US presence. So you've got your pre-revenue stage, and this could be when you're just simply doing some market research to figure out whether or not there's a market in the US for your particular product, what are the types of things you should be thinking about. Maybe if you start selling into the US, again, Gabe's going to talk in quite some detail about state and state sales taxes, because those can be very, very complex. And then we've highlighted here what are some of the risk. Have you accidentally triggered a US taxable presence for your Estonian company? Do you have any sort of filing requirements? Just want to make sure you're covering off any of the compliance. So again, questions you should be asking yourself. Then there's if you're just starting to have that US presence, what does it mean from a tax perspective? If you've got Estonian employees traveling to the US and perhaps performing some kind of activities, what does that mean for the Estonian company? Have we triggered any kind of risk for the Estonian parent company? Any filing obligations? Could you potentially be creating tax issues, individual tax issues for those employees that have traveled to the US? And always sales tax again. And then kind of the almost the peak of your US expansion life cycle. You've got that fixed US presence. How are you structuring the sales to your US customers? What's actually happening? Those boots on the ground in the US. Again, do you still have appropriate intercompany agreements in place? All of those sorts of things. So I think this is a good page to hopefully help trigger discussion as you're talking to your advisors about what should I be thinking about with respect to my US operations today, tomorrow, and 18 months from now. There we go. So just want to give you kind of the landscape of US taxation. If you've got US tax, okay, who does the US seek to tax? If you're a US citizen, resident, corporation, they are taxed full stop on a worldwide basis regardless of source of income. So myself personally, Gabe, as US citizens, we pay tax in the US on our worldwide income, same as a US corporation would do. That corporate tax rate today is 21%. If you've been watching the news at all last year and this year, there has been, it's kind of ebbed and flowed a little bit, but there's been some momentum around increasing the corporate US tax rate. So President Biden and various houses of Congress have introduced certain proposals that have called to increase that corporate tax rate up to potentially 28%. Though it's gone a bit quiet. The last bill that included something, an increase to the corporate tax rate, sort of fell over quite quickly. So although that rate is being floated out there, I think it's more a watch this space, because there's a lot of resistance in Washington to raise that corporate tax rate. So for individuals, just for your reference, the top the top individual tax rate is 37%. Some proposals to increase that, and state and local taxes would apply on top of that as well. So that's how we tax US persons. How do we tax non-US persons? So if you've got an Estonian company, there's basically two ways that the US will seek to tax the income of that Estonian company. The first way is if the Estonian company has what we call income effectively connected with the US trade or business. You may have heard the term ECI. So what that means is that Estonian company has done something in the US where they've got a taxable presence. So for example, if you sent employees over to the US and they set up an office, employees of the Estonian company, they set up an office, or they were performing services and they were in the US for quite some time, that income that's connected to what's happening in the US could subject that Estonian company to US tax on that ECI income. And you'll see, we'll talk in a few pages about ways to manage that. And most clients I work with don't want their Estonian company within the US tax net. So there's that sort of trader business income. And then there's also what we refer to as FDAP income. What that really is passive types of income, dividends, interest, rents, royalties, like license fees. We withhold at 30% on those. So if you've got a US customer, for example, that's paying you a license fee, if they pay you a license fee of 100, we will charge 30% withholding. So instead of them paying you 100, they'll pay you 70 and remit that 30% back to the Internal Revenue Service. Now that can be reduced under treaties with the US and Estonia. Luckily, Estonia does have a treaty with the US, so we can get that down to something a bit more palatable. I've got one line here about sale of US real property. Anytime anybody who's non-US wants to sell any kind of US land or buildings, the US always seeks to tax those gains. So that's just something to be aware of. So that's sort of the federal income tax landscape. And then Gabe's going to talk just briefly about state and local taxes. Sorry,
Sure.
there you go. Thanks, Gabe.
Yep. Yeah, so the state and local tax landscape, encompasses a wide variety of taxes among the various states, and this list, covers the main ones. I mean, at the state corporate income tax level, that's kind of what people may be familiar with, because you may be familiar with the U.S. IRS and federal corporate income tax. And so most of the states will have some version of a corporate income tax. In addition to, or sometimes in place of, the income tax, some states will have a franchise tax, which can be a tax on simply the privilege of doing business in the state. Sometimes the franchise tax may be measured by the amount of authorized shares. Net worth taxes can be based on a variety of calculations around the company's net worth. So each of the states is going to have their own way of calculating their own calculation for their state franchise tax or their net worth tax. And again, that the franchise and net worth taxes may be in addition to the corporate income tax. So, you may have to pay both in a state, or it could be a replacement, depending on the state's rules. Gross receipts taxes, tend to just be on the raw, gross revenue received by the company without any allowance for, any kind of costs or deductions. And again, those may be in place of or in addition to the state corporate income taxes. Sales and use tax, 46 states in the District of Columbia have a sales tax. There are 5 states which do not have a state level sales or use tax, but those tend to be, traditionally on sales of tangible personal property and sales of physical goods and some services that we'll get into in a bit. But, that tends to be one of the trickier areas, especially for remote sellers or inbound companies selling from outside the United States to US customers. So we'll cover that in some length. Property taxes, are generally going to be imposed on real property or on personal property, meaning physical property that's used by a business in the course of operating its business. So we might think of machinery and equipment that's placed in a particular state, or sometimes inventory that is stored in a state may be subject to a personal property tax. Employment taxes, each state is going to have their own set of rules, but generally we'll impose employment taxes upon the wages that are paid to employees in their state. And some states, I think where it becomes an issue is when you have employees who cross state lines or may work part of the year in one state and then part of the year in another state, or as part of their job they are traveling to various states. There can be complicated tracking that needs to take place in order to determine in which state you need to pay those state employment taxes. And finally, transfer and recordation taxes, those will generally apply to either a transfer of real estate, or they can apply to the transfer or sale of an entity that itself owns real estate. So it's sort of a step removed from the direct sale of real property, but to the extent that the state imposes that kind of a transfer tax, there may be analysis that needs to be done around the potential tax implications when you're just selling a company which owns real estate in the US. And I think we can go on to the next slide. So we're going to get into remote sales, and this is going to cover a lot of the topics that inbound companies selling from outside the United States to US customers may encounter. And we'll cover some of the nuances of US sales and use tax, as it generally will have some major differences, especially for European companies and for those folks who are familiar perhaps with European VAT. There are some fundamental differences in the way the US sales and use tax operates, so we will get into that. Next slide. So just at a basic level, the sort of typical fact pattern is you'll have a non-US seller located outside the US. They're going to sell either goods or services to a US customer, so the non-US seller is contracting either directly with the US customer, or they may have a US subsidiary or some affiliate perhaps in the US that is engaging with the US customer directly or contracting with the US customer directly. We'll get into marketplace providers, but generally those are the two main fact patterns: either non-US seller selling directly to the customer, or there might be some intermediary party that is perhaps interacting with the US customer or perhaps acting on behalf of the non-US seller to help them make sales to US customers. We can go ahead to the next slide. So as I mentioned earlier, 45 states and the District of Columbia have a sales and use tax. However, in addition to the states, you have local jurisdictions also that will levy sales and use tax. So counties, cities, special taxing districts, and each of them may have their own tax rules. But generally, the sales and use tax is levied against the purchasers, but the seller may have the obligation under the state's rules to collect the tax. And so, ultimately, if there is non-compliance or the state tax department comes after the seller, or challenges the transaction as being taxable, it's generally the seller that's going to have that obligation to the state for the sales and use tax that is due. Sellers generally need to have a sufficient connection to the state in order to be subject to sales and use tax, and that connection is what we call nexus for sales tax purposes. So it's the level of connection to a state, and it can be either traditionally a physical presence, having an office, having employees, some kind of physical presence within the state, which will give you nexus. In the last few years, we've had some developments that we'll get into where states are imposing the sales tax collection obligation on companies that have a sufficient volume of sales into the state, so no physical presence required. And that is generally where we see a lot of inbound companies getting tripped up or having obligations triggered, is because of those economic nexus rules and having a large enough volume of sales in the state. But to the extent a seller does have nexus with a state for sales tax, they're going to be obligated to collect that money, hold it in trust on behalf of the, on behalf of the states, and then, remit that on the sales tax returns. The sellers can be jointly and severally liable for failing to collect the tax, and like I mentioned, usually the state is going to go after the seller for the tax that is due. Audits are generally going to focus on the seller because the seller is a lot easier to audit than 5,000 or 500,000 different customers. So it's just easier for the states to go after the seller in auditing and assessing that tax due. And oftentimes, the sales tax is it is imposed at the time the transaction occurs, and it's generally paid over on the sales tax returns for that month. So sales tax returns tend to be filed on a monthly basis, sometimes on a quarterly basis. So it's a very, the tax is collected contemporaneous with the purchase and then reported to the state. So one of the difficulties upon audit or, upon trying to do some remedy later on is that it's very difficult for a remote seller or for any seller to go back to customers later, whether it's months or years later, and try to recover the tax from customers, to contact the customers. That it tends to be an administrative burden to try to get that transaction taxed later, as opposed to contemporaneously when it traditionally is taxed. We can go to the next slide. So I mentioned a bit earlier that there are some fundamental differences between U.S. sales and use tax and VAT. One of the main differences is a VAT tends to be uniformly applied at a national level, and for sales and use tax, the rules vary dramatically from state to state. There is some basic uniformity, but the nuances around what is subject to sales tax, any applicable exemptions and exclusions, that tends to vary from state to state. And like I mentioned, in addition to just the states imposing tax, you have the cities, the counties, and the local jurisdictions. And so taken together, there are probably over 10,000 different taxing jurisdictions in the US for sales and use tax, which may have varying tax rates and varying tax bases. So the complexity tends to multiply very quickly once a company begins going into the US market. For VAT, generally we will see both goods and services being subject to the VAT. In the US, traditionally only physical, tangible personal property, physical goods are going to be subject to sales tax in most states. And if there are services subject to sales tax, they are generally going to be specifically listed, specifically enumerated services that are subject to sales tax, rather than sort of a blanket application of the sales tax to services. One of the other differences is the US sales tax tends to be on the final consumer or user of the property or item being purchased. And so unlike VAT, all along the chain for US sales tax, there's generally resale exemptions which will apply. And those are going to be documented using exemption certificates. But generally that allows the transaction through the chain of transactions. It allows for sales tax to not apply until you get to that final consumer, that final customer that's making the end purchase. And that is generally where the sales tax is going to apply. So, as I mentioned, there's unfortunately not a lot of uniformity in the US for US sales tax. There are some efforts to create model rules. There's what we call a streamlined sales tax effort in the US. So an effort to make uniform definitions, uniform taxability rules. The states tend to adopt these voluntarily, but each state is free to generally set its own definitions, to set its own tax rates, and to set its own exemptions and exclusions. So that tends to be different from maybe sort of at a national level, a uniform VAT, where the rules are the same, regardless of what city or part of the country that you're in. We can move on to the next slide. So with regard to nexus or the connection that a company needs to have, there are various ways that the states over the years have devised mechanisms under the law to impose the sales tax on companies. So I won't go through every single state here, but you can see sort of the variety among the different methods, but I'll just, as an overview, describe each of these. We have click-through nexus. what click-through nexus generally encompasses is, the typical scenario is you'll have a company that uses a website link, maybe on a company's website, and when a customer clicks on the link to purchase a pair of shoes or to purchase a t-shirt or something, there may be some commission for referring the customer, and that is paid, and the states generally will look at that relationship, with the company putting the link on their website and the seller, and they'll try to make the assertion that there's a sufficient connection to the state because you're using an in-state party to help you solicit sales by putting that link on their website. So click-through nexus rules are trying to capture that activity where maybe the seller is not physically present in the state, but they have a relationship with somebody in the state, and that in-state party is using some kind of link or maybe some kind of commission relationship to solicit sales on their behalf. And then going down the list, affiliate nexus refers to generally a related entity. It could be a subsidiary oftentimes, but some kind of related entity to the seller that is in the state operating or engaging in some kind of activity on behalf of the seller. So it could be the solicitation of sales traditionally. It could be the affiliate engaging in customer relations or customer service activities. But if to the extent that the affiliate has nexus or has a taxable presence in the state, states with affiliate nexus rules assert that the in-state affiliate is acting on behalf of the out-of-state seller, thereby giving that out-of-state seller nexus. And so that through that relationship, the state asserts, that the out-of-state seller has a taxable presence and therefore has an obligation to collect sales and use tax. Notice and reporting rules are not quite so common anymore, but before Wayfair, notice and reporting rules required a seller to basically report on their customers. So to report to the state who they were selling goods to when they didn't collect the tax. They generally tended to be very onerous reporting requirements, and sometimes they required the seller to put a notice on their website or on their invoices, notifying the customers that sales tax was not being collected and that the customer may in fact have a use tax obligation to self-report to the state. So it was kind of a way for states to prompt either their customers to self-report the tax or to provide information to the state about who the seller was selling to, so that the state would then have information around which customers may have a use tax obligation in the state. As we've gotten into economic nexus, which we'll get into in a bit, the use of notice and reporting rules has become less and less common. But before we had economic nexus from the US Supreme Court Wayfair decision, these notice and reporting rules were a way for the state to prompt a seller to either comply with these requirements or choose to collect the sales tax. And historically, the requirements were so onerous that many simply chose to collect the sales tax because it was simply easier than complying with these rules. Marketplace provider rules, that tends to be almost every state now has a marketplace provider or a marketplace facilitator rule. And what that is in a traditional sense, sort of a website that you go to and you can find a list of goods and services or a list of goods traditionally to buy from various sellers. So we all know the main sort of marketplace facilitators in the world now, but generally you'll have a company that is setting up a website, and on that website, various sellers can sell their goods. What the marketplace facilitator rules do is shift the sales tax obligation from the underlying seller to the marketplace that is hosting the platform. They're hosting the website, which allows customers to find the goods, to search for the goods, to find various sellers. And this really made it easier for the states to collect the sales tax rather than going after the myriad of, the large number of potential sellers that are selling through these platforms. The states can simply now require the platform itself to be the taxpayer for sales tax purposes. So like I said, almost every state now has this marketplace provider or marketplace facilitator rules, which can be onerous if depending on the sales model that a non-US seller is using. And finally, what we call cookie nexus, that is also not quite so common anymore now that we have economic nexus. But cookie nexus was really the idea that an out-of-state seller could have a sufficient physical presence with the state simply because the taxpayer may have, or the customer may have gone to the seller's website, to look at goods or to make a purchase, and perhaps there were electronic cookies that were downloaded onto the customer's computer. So this was kind of a very novel idea that I think Massachusetts first came out with, that those electronic cookies might constitute a physical presence, and therefore give the out-of-state seller nexus with the state. Now that we do have economic nexus rules, we don't tend to see a lot of enforcement or activity around the cookie nexus idea, and there were some court challenges around the application of those rules, but some of these states still do have them on the books. So this map shows states that do have sales tax economic nexus provision. So today in 2022, every state that has a sales and use tax now has adopted a economic nexus provision. So under those provisions, if a company, whether they're in the US or they're outside the US, has a sufficient volume of sales into a state, that will trigger the sales and use tax registration and collection obligation. And what this chart shows at a high level is, unfortunately, each of the states adopted these economic nexus rules at different times. And so, there's different enforcement start dates in each state, and the thresholds tend to be different, which we'll see in a bit. But oftentimes there's a burdensome tracking mechanism or exercise that needs to take place to figure out not only when you have exceeded the state's sales threshold and therefore have an obligation to begin collecting sales tax, but also looking backward historically, trying to figure out when each state's rule became effective so that you are collecting the tax that you had to collect from the moment that the obligation began. So you'll see most of the states tended to adopt rules in 2019. The US Supreme Court Wayfair decision, which prompted the economic nexus provisions to be adopted, that decision happened in the middle of 2018. You saw some of the states in 2018 begin to adopt those rules, but by 2019, you'll see the majority of states began adopting them. And I think we have a couple of states where it's not, I think Missouri's rule is not kicking in until 2023, but the majority of states now have an active rule in place. So each of the states has a different threshold for when the sales and use tax collection obligation begins. And most of the states do tend to have around $100,000 or 200 transaction threshold. So once a company in a year has $100,000 of sales in one of those states, or has 200 separate sales into the state, the obligation will be triggered for that particular threshold. Most of the states, like I say, have $100,000. You have a few outliers like New York, California, Texas that have larger $500,000 thresholds. The other thing that becomes tricky is sometimes the sales threshold has changed over time. So, an example would be Arizona. Now it's $100,000. but it used to be $150,000, and then the year before that it was $200,000. So you can see that trying to track when your obligation began on a state-by-state basis, and also when each of the states may have changed their rules over time, becomes a complicated activity. So for inbound companies, on a specific level, once you're sort of at the threshold, once you've exceeded economic nexus, you have the obligation, you're going to have filing requirements in each of the states. You're going to have to register, usually with the state taxing authority, but there may be some states, Louisiana, Alabama, where you may also have to register in Colorado with the local taxing authorities, be it the city, the county. And so the registration obligation can be, more than just a single form. Once the registration's in place, you're up and running, you have your sales tax license in the state. Inbound companies are going to need to have a robust sales and use tax compliance function. They're going to need to have a system in place to help determine all of the varying taxability rules, to help manage all of the different sales and use tax rates that are varying by each state. There are varying software solutions that are used, and sometimes it's managed in-house, sometimes it's outsourced. But because the returns tend to be monthly, once you have an obligation in 10 states, you'll get into the hundreds of sales tax returns that need to be filed per year pretty quickly, as your business begins to grow in the US. One other consideration for inbound sellers is sometimes, the business begins growing in the US, and by the time there's an evaluation of the sales tax obligations, we may find that there's prior exposure for past periods. And so you'll need to look at potential retroactive enforcement of the state's rules. To the extent that there's no sales tax and use tax return, or there's been no sales tax collection ever, usually the state's statute of limitations, which tend to be 3 or 4 years, may not apply. So, to the extent that there has never been sales and use tax returns filed, it's possible that the sales and use tax obligation may go back as far as the first sale into the US, depending on the particular fact pattern. Like I said, given the high volume of returns that are generally at play when doing sales tax, you'll tend to see increased compliance costs that can increase exponentially, particularly if an inbound company is focusing on the US market or is planning to enter the US market. They'll need to be planning around the compliance costs and the compliance function, because the burden will increase rather quickly. The other thing I want to mention as well is, the rules tend to change a lot in sales tax. So every year there's sort of updates to exemptions, exclusions, the threshold amounts. So to the extent that those rules are changing and being updated, there's often maintenance that needs to take place to determine how your compliance function is keeping up. The other thing to think about is if there are existing relationships with, let's say, marketplaces or vendors, the rules as they change over time may shift the sales tax obligation from the seller sometimes to the marketplace facilitator. Sometimes there may be reporting requirements for both the non-US seller and the marketplace facilitator. So depending on the rules, there could be shifting obligations for either information reporting or the actual sales tax collection and remittance obligation itself. So the risks for non-compliance. So, there are, significant risks for and challenges for trying to comply with the varying rules and the constantly changing rules that are taking place in U.S. sales and use tax. But eventually, eventually the obligation will be there. The states are still kind of grappling with as far as enforcement mechanisms, especially for non-U.S. companies, because oftentimes the thought is, well, I have no office, I have no property, I have no employees in the U.S. How can the state come after me? But the unfortunate thing is that the exposure will not go away. And so as time goes on and a company wishes to enter the market and become more established in the U.S., trying to not only get the sales tax collection function correct now and begin collecting, but trying to do any remediation that may need to take place for prior periods, that will need to be considered. And most of the states will provide some mechanism for remediation, whether that's a voluntary disclosure agreement, informal negotiations with the state to sort of remedy and get up to speed with your sales tax obligations. There are varying ways that the states will work with companies that need to come into compliance. And like I mentioned earlier, setting up and maintaining the compliance system, it takes significant planning. And so oftentimes it's to the company's advantage to begin that process before the first sale takes place in the US. And in a perfect world, that would take place. We know that that doesn't always happen, but to the extent that the planning can take place, that there can be preparation for the registration obligations, that will greatly reduce any potential prior period exposure that the non-US seller may run into. And I think we'll get into setting up US office operations. And I don't know, Jillian, I can hand it back to you at this point.
Excellent. Thanks, Gabe. And that last point Gabe was making, I think, is really important. I was just on a call with a client this morning, and they were talking about a diligence they went through, and sales tax obligations was what came up in that diligence. And there was definitely a chip on the purchase price when they were going through with that sale. So definitely something I know Gabe comes across quite often. There's a reason we spent so much time on this. It's complicated and it comes up a lot. So what we've talked about so far is if you're just the Estonian company and you are selling your product or licensing your software or somehow providing services remotely, how the US might seek to tax the Estonian company. But it's important to note that all those rules that Gabe just talked about, that also applies if you set up an actual US subsidiary. So US companies that are doing exactly the same thing are facing the same sets of rules and the same sets of complexity. So this next section, we're going to talk about, again, setting up a US office or a legal entity, perhaps. So this is a question we get a lot. I'm going to set up a US subsidiary. What should I set up? Should it be a US Inc.? It's sometimes referred to as a C corporation. A US Inc. and a C corporation are the same thing. So that's sort of one and the same. Or we'll oftentimes see a US limited liability company, an LLC. So the big difference between a US Inc. and a US LLC is the default tax treatment. So both of them generally provide legal liability for the owners. I mean, there's legal liability protections with both of them, but a US Inc., a corporation, is treated as a corporation for US tax purposes. An LLC, if you, Estonian company, went and set up an LLC and you own 100% of the membership interests of that LLC, for US purposes, we're going to treat that as what we call a disregarded entity. It's tax transparent for US tax purposes. That's just the default treatment. So if you just went and set up this LLC, we would view it as just a branch of your Estonian company, and the Estonian company would still be the technical US taxpayer. If you talk to Rano about it, he'd say, well, I would view that LLC as a corporation. And so you get into this mismatch treatment where your home country sees it one way and the US sees it another way. We often call that like a hybrid entity because you get two different treatments. That's usually not a position you want to be in and can oftentimes result in double taxation. So if you're going to set up an LLC, if your US legal counsel, for whatever reason, recommends an LLC, what you can do, and you might have heard of this, is file what we call a check the box election. We call it a check the box election because it's about a 3-page form right now. And what you literally do is tick a box and you tell the IRS how you want the IRS to treat that entity, in this case, an LLC, for US tax purposes. So it's sort of a helpful sort of kind of taxpayer friendly, actually, where you can go in and say, well, I'm an Estonian company. I don't want to deal with these hybrid issues with my LLC. So I can go in and check a box with the IRS, and going forward, it'll be treated as a corporation for US tax purposes. So I think probably 99 times out of 100 when I'm advising clients, if you've got a non-US owner of that LLC, we'll recommend that you file that check the box so you get the same treatment in headquarters and the US. So it's something that might come across as you're planning your US expansion, just be mindful of. Another question we get a lot is, well, where should I incorporate my state, or where should I incorporate my US subsidiary? I've done some Googling and I think Delaware is going to be brilliant. There's not necessarily a whole lot of magic to Delaware, but the reason the reason you see a lot of corporations organized in Delaware is it just tends to be quite business friendly. I think both from a legal perspective and from a tax perspective, it's quite easy. Again, very business friendly. If you start working with Gabe on your different tax filings in Delaware, it'll be quite simple. So most of my clients just tend to organize their subsidiaries in Delaware. There's not any sort of super magic to that, but again, it just tends to be quite business friendly. You can have a subsidiary in Delaware and never do any business, never have a single customer, never have a single employee, nothing to do with Delaware. And that same company can have operations in the 49 other states, and that's perfectly fine. You don't have to set up a company in every single state where you're doing business. So just something to keep in mind. So why might you set up a US legal entity? So if you're doing your business and so far you've been fine with the remote selling, oftentimes what I'll see is, well, we've been remote selling and we're getting some traction, but we think if we actually had people in the US who could push our product, who could demo our product, meet with potential customers, that sort of thing, be a real-time resource, perhaps, that we would get more market traction in the US if we had that physical presence. So most of my clients, if they're going to have employees that are physically present in the US, so let's say you want to set up a sales and marketing office, we almost always recommend that you incorporate a US legal entity, because what you can do if you incorporate a US legal entity, if you've got people in the US, is you can effectively, for tax purposes, draw a box around those US-based activities, and we'll get to it in another slide or two. You can, if structured properly, limit your US tax filings to that particular legal entity. Again, ring fencing all of the US tax filings and compliance, and hopefully the US tax liability in that US entity. And again, keep your headquarters, keep your Estonian company outside the US tax net. So that's oftentimes when we'll recommend a US legal entity if you're going to have people and sometimes even property. So if you're going to have a warehouse, for example, or you're simply holding legal title to goods that are sat in the US, oftentimes we'll recommend a US legal entity. So those are sort of internal business drivers that might push you to set up a US legal entity. I also come across quite a lot customer requirements to have a US legal entity. So for example, if you were contracting perhaps with the US government, certain US customers who might have Buy American mandates, I've definitely seen US-based customers who will require you to have a US legal entity because they don't want to contract with an overseas entity, for example. And so if you've got a customer who's got a lot of buying power, and you might be motivated to say, well, if this is what the customer is demanding, this is their standard contract, and this is going to be a very significant contract for my business, then a lot of my clients will be willing to, well, I'm going to set up a US legal entity because there's no way I'm going to pass up this opportunity. So sometimes customers will demand it. Another one I see is if you need to set up a US bank account. A lot of my clients have a lot of difficulty without a US legal entity or somebody with a social security number setting up an actual US bank account. So I've had clients who don't have any physical presence in the US, but they've had to set up a US legal entity simply to get that US bank account. Sometimes it's because they want to have, for example, US credit card processing. I've seen that with a number of clients where you're using, for example, Stripe, the European Stripe company to process credit cards, and your US customers are going on trying to buy something online with a credit card, and it's going to an overseas payment processor, and the banks reject it. And you get a bunch of credit card rejection costs, and you're losing sales. So sometimes you might want to say, well, I'm going to set up a US legal entity. That way I can set up, for example, Stripe US account with my US bank account and avoid those costly credit card rejection and just lost sale opportunities. So there's a number of reasons why you might want to set up a US legal entity. Again, tends to be a C Corp or an LLC that's checked to be a corporation. Oftentimes we see Delaware, but I mean, other states can work as well. So you can turn the page. Okay, so let's just assume that we've set up a US legal entity. So in this picture here, the middle two pictures are going to represent my US legal entity in this supply chain. So if you've got a US legal entity and you've got your Estonian, say just the Estonian headquarters company, and then you've got your US customers, what does that supply chain look like? Who legally contracts with who? What kind of intercompany agreements do we need? Sort of who does what in the entire sort of sales cycle here. There's two general models that we tend to advise on, and most clients will use, and they tend to work for most circumstances. The first one is the top here, what I call the services model. So the big difference between the services model and the distributor model we're going to talk about is who is legally contracting with your US customers. Okay, in the services model, your Estonian HQ headquarters legally contracts with your US customers. Okay. If we've got a US legal entity, so let's assume we've got a US subsidiary as well. Oftentimes when companies will use the service model will be, well, it's early days in the US, but I want to set up a sales and marketing office, for example. I'm going to hire 2 or 3 people. They're going to, let's say it's some kind of software, some kind of tech product. They're going to go to potential clients and demo the product. They might go to trade shows. They're just trying to do some business development type activities. So when you use a services model, again, the customer contracts tend to be with the Estonian parent company and the US customers. So what'll happen is when you've got that sales and marketing team, they'll generate some of these sales leads, but then they need to pass those sales leads back to the home office. And all of that contract negotiation and concluding those contracts needs to happen when people from the business are outside the US. Okay, and the reason I say that is because if you go with the services model, the real sort of the plus side is it's sort of minimal investment and you're not shifting a bunch of value into the US entity. So if it doesn't work, you can just easily wind it up, right? You've only got a couple of employees, you're not shifting contracts or anything like that. But the real downside to this model, and when we got to start thinking about maybe jumping to the other model I'm going to talk about, is you have to tie the hands of your US based employees. So that's employees of the US subsidiary. And if you have employees, for example, of the Estonian parent company that are traveling to the US. What's absolutely critical with this model is that anybody from the business who's in the US does not materially negotiate or conclude customer contracts on behalf of the Estonian company when they're in the US. Okay, so no concluding contracts in the US with those US customers. The reason you don't want to do that, because if you do conclude those customer contracts, you're very likely creating both a federal and state taxable presence risk for your Estonian company. You've got this valuable customer contract. Now, all of a sudden, some of that revenue could be pulled into the US tax net because the US authorities will say, you've got what we call a permanent establishment in the US. You've got a taxable presence in the US because you've crossed that line. So this model can work. Tends to be, again, kind of early days, or if for whatever reason your customers are sort of indifferent and they can just do all of their sales, for example, online, something like that. Okay, the distributor model. I'm going to go to the second model here. So the big difference here is where are those customer contracts? Under the distributor model, you've got two contracts here. So you've got your Estonian headquarters that will sell the product or, license the software, license the tech to your US subsidiary. That US subsidiary will then resell that product or sub-license that tech to your US-based customers. What we like about this model is you've basically nearly eliminated that US taxable presence risk for your Estonian HQ. Because anybody who's going to be negotiating contracts while they're on the ground in the US, they're not negotiating contracts on behalf of the Estonian entity. They're negotiating contracts on behalf of the US entity, and the US entity is already paying US tax. So you've effectively untied the hands of the sales and marketing personnel that are sat in the US by using this distributor model. Some clients I work with will, if they're trying to figure out whether or not there is a market, will start with a services model, but as soon as they get traction and as soon as they get a sales team that they can trust in the US, they oftentimes then flip into the distributor model. I've got some clients that I work with who will just immediately go straight into the distributor model. Very much depends on the facts and circumstances. Who are you hiring in the US? I mean, are these people that are known and trusted employees, or are these brand new people? That sort of thing. But tends to be one or the other. In both instances, I would expect that the US legal entity would have some amount of taxable income left and pay some amount of residual tax on that taxable income, because in both instances, we would want to apply transfer pricing principles, and transfer pricing principles apply when you've got related parties entering into some kind of transaction. So in my services model, my US subsidiary is effectively a service provider because it's providing sales and marketing services support services. So under transfer pricing principles, I would expect the Estonian company to pay the US company for those services. So what you tend to see is some kind of, we don't want to get too technical, some kind of cost plus markup. So if you pay your US personnel 100, under transfer pricing, you might say, well, that should be a cost plus 10% markup. And so my US company has 110 of income, less 100 of expenses. And so you just pay a little bit of US tax on that 10, on that delta. Versus the distributor model, which tends to be a slightly different transfer pricing approach, where you look at total sales, and the US entity should effectively retain a percentage of that sales income to pay it for the service that it's performing. Ultimately, the goal tends to be with both of these models is that your upside, your risk, and your reward is borne by the Estonian entity. So if the product's a flop in the US and you hardly make any money, it's the Estonian entity that's taking that risk and bears that risk of loss. But the upside is if your product or service is really successful in the US, then all of that residual income also stays in Estonia. So you're limiting your upside and your downside risk in the US, but limited risk, limited reward in both instances. Okay, if we can go to the next page. And again, this kind of summarizes what we just talked about with those last two models. Very important to most of my clients I work with, that they don't want their headquarters, they don't want their Estonian parent company to be subject to US tax. And if we're setting up a US legal entity, what can we do to make sure that all those US tax filings, especially if you have a US legal entity, all those tax filings and tax obligations sit with the US legal entity, and you don't have residual tax payment and filing obligations within Estonia. So it's important to monitor what we just talked about there, is that you're not doing anything that could cause that risk to the Estonian company. And the one we see the most is if you've got somebody in the US who's negotiating and concluding contracts on behalf of the Estonian company. Okay, that's the important part. That's where we tend to see it the most. And one comment here, which we just talked about, is transfer pricing. When you choose a model, then it's important to do some level of transfer pricing review to make sure that you're rewarding the parties for the functions and risk that they're providing. So your US company and your Estonian company, because both sides of the intercompany agreement are going to want to make sure that they're getting the right amount of money based on what's happening in country and the risks that are borne there. Okay, and then Gabe, if you could please cover, I know we talked about sales taxes, but I mean, as I said at the beginning, Gabe's job is much harder and he's got a lot more taxes to cover than I do.
Sure. For state income tax, you'll have a little bit of a different nexus analysis. So, for most states, you'll have a taxable presence or nexus if you have some kind of physical presence in the state. So, having an inventory, having a warehouse, any kind of, employees or property in the state will generally be sufficient. You may also have agents acting on your behalf in the state, and that could be sufficient to give you nexus for income tax purposes. There are some states that have what we call bright line or factor presence standards, and that's kind of similar to economic nexus. So as an example, the state of Colorado will assert nexus for income tax if you have $500,000 of sales into the state, or if you have $50,000 of payroll in the state, or if you have $50,000 of property in the state. So if you meet any of those thresholds, then you will be presumed to be a taxpayer for income tax purposes in the state. So the actual dollar amount of the threshold tends to vary from state to state, but the idea is the same, that if you have some amount of sales or property or payroll in the state, that will be enough to establish a taxable presence. States are also attributing nexus based on some third party acting on your behalf in the state. So maybe you don't have an employee in the state, but you hire independent contractors, or maybe it's not your employee that's in a state soliciting sales, but it's a related subsidiary who has employees in the state. The states will attribute nexus based on some third party that is acting on your behalf in the state to help you establish a market for your sales. So oftentimes we need to look at not just, where employees are located, but also any kind of agents or independent contractor relationships. And finally, it's important to keep in mind that while there may be U.S. tax treaties, those generally will apply at the federal level. And so the states are generally not going to be party to those treaties. And so while there may be, U.S. treaty protection or treaty considerations that will take place at the federal level for federal corporate income tax, that you may still have state income tax obligations because of that disconnect where the states are not a party or do not subscribe to those treaties.
Excellent. Thanks, Gabe. So now we're sort of at the last, remember at the beginning when we talked about that growth cycle, and you've determined there's a market for your products. You've done some remote selling. You've set up a U.S. office, but now you found that your U.S. activities have been quite successful. So your U.S. entity is making a lot of money in the U.S., and you need to get that cash that's accumulating in the U.S. back to your Estonian HQ, right? So remember what I said is that the U.S. levies tax by way of withholding on dividends. So if you've got your U.S. subsidiary and it's accumulated some cash and you want to give that back to the home office, if you pay a dividend out of your U.S. subsidiary, that dividend is going to attract 30% withholding tax in the US. That's just the statutory rate. So if I pay 100 dividend, I can actually only pay 70 because I've got to remit 30 as withholding tax. Helpfully, because we've got a double tax treaty in place with the US and Estonia, if that Estonian company qualifies for those benefits, we can get that down when you've got a wholly owned US subsidiary to 5%, which I think is obviously much better than 30%. Important to remember that just because you're an Estonian company doesn't mean you can automatically apply that 5% rate. Our treaty with Estonia, like almost every single treaty that we've got with the US, has anti-treaty shopping provisions, and you've got to go through those and work out which of those tests you satisfy to make sure you can unlock those benefits and access those benefits. And there's filing obligations that come along with that, where you've got to actually sort of tick the box to say which test you meet. I'm sure probably a lot of people on this phone call have been presented with the form W8 Ben E, which looks very, very complicated, but I promise it's not as complicated as it looks. But if you were to, for example, have your U.S. company pay a dividend to your home office, that's a form that would need to be in place. And so you need to think about if you are eligible, in fact, to get to that 5% rate, and just make sure you are. Ideally, if we've implemented one of those two operating models we just talked about, you're using transfer pricing and intercompany agreements to try to keep that cash accumulation in the U.S. as low as we can. So you're not paying the 21% US tax plus Gabe's income tax, and then suffering that 5% withholding tax on top of that. And so ideally, we're keeping that cash accumulation as low as we can. Again, via transfer pricing, intercompany agreements. And I've just got a couple more things to talk about. Then Rano's also going to apply the Estonian overlay to those withholding taxes. So go to the next. So we've talked about a lot today. It's U.S. tax. It's complicated. We've kind of just scratched the surface here. But when we have calls with clients, when we're discussing a client's particular fact pattern, what they're doing now, what they're planning to do, what we've covered today is what most clients want to talk about, and kind of tends to cover off the most key, the key bits with actually sort of setting up and getting that operating model correct in the first instance. But it's also important to keep in mind U.S. tax compliance. The IRS and the state tax authorities love paper, and there's lots of forms and lots of information reporting, and all of those forms and information reporting can attract penalties and interest if you file them late or if you miss them. So it's important to sort of keep your eye on those various due dates, and especially with all the states and all that, just so you're not paying any silly penalties or interest that you don't need to be. Also important to think about funding your US. So if we're setting up a US, how do you get cash into that? Should I fund it? Should I loan it all? Should it all be debt funded? Should I just make equity contributions? What sort of makes sense? I'll tell you a rule of thumb is we generally recommend some kind of blend of debt and equity rather than fully debt funding. There's also employment taxes, both at the federal and the state level. And then lastly, individual income taxes. A lot of times, if you're just starting to venture into the US market, you might send those experienced, trusted staff from Estonia who've been with you for a while, might be the founder, him or herself, that are traveling to the US. And if they're spending any amount of time in the US, you could be tripping an individual tax filing or payment obligation for that for that employee. So just something to keep in mind, because you'd hate to have a trusted employee doing something for you in the US, then all of a sudden they're hit with a big tax bill that they might not necessarily have been thinking about. I could probably add 10 more bullet points to this list. I mean, there's customs and tariffs and all of that. I think in summary, what our ask from you today would be, if you are remote selling, or even if you've got a presence and you're selling in the US, to make sure that you review your sales tax profile and make sure that you've thought about whether or not whatever you're providing is subject to sales tax, and if it is, to make sure that you're collecting and remitting that, because again, that's something that comes up a lot on diligence. And if you do have an established US presence already, I think it's always important to sort of sit back and look at that and review and make sure it's actually sort of fit for purpose. And of course, we're always sort of available to chat through any particular facts with your specific company or your business. And with that, Rano, I think I've left you 5 minutes to cover the Estonian overlay, if you'd be so kind.
Yes, thank you, Gillian. Thank you, Gabe. It was a very good overview, and I will contribute with one slide about Estonian taxes. So it's purely about Estonian inbound, outbound payments. But let's look now this table on the next slide. Yes, and Estonian tax system is really simple and rather straightforward. So if we speak about inbound payments that the Estonian entity is receiving from the United States, then of course we heard about US taxes, but from Estonian point of view, basically the corporate income tax is postponed. So any income is taxable only if you distribute it. And if we speak about taxes paid in the US, then these can be credited against the tax payable in Estonia. But of course, you need to prove that this was the tax really paid in the United States, and also that this was within the limits of tax treaty. So if you pay more than required by the tax treaty, then this exceeding part is not credited in Estonia. And what I would like to stress also regarding dividends is that because United States is not in the EU, of course, then we have to prove that tax has been really paid in the United States, because within the EU we are used to the rule that dividend participation exemption is applied if dividends are received from EU entity, and you don't need to prove like real tax payment. But if we speak about US, then you need to prove that taxes have been paid in the United States, deduct those from taxes payable in Estonia, or to get full exemption. If we speak about outbound payments from Estonian entity to finance or to contribute to the US entity, then I would like to stress that there is corporate income tax payable in case of dividends. So it's not withholding tax, so tax treaty is not reducing it. So that's a very common question. People are reading tax treaty and hoping that tax treaty could decrease the Estonian corporate income tax payable, but this is not the case. So there is no withholding tax if we are paying to corporate entity in the United States, but there is corporate income tax payable, either 0%, 14% or 20%, depending on different rules. No withholding tax on interest payments, but there is withholding tax if license fees are paid to the United States. So either 5% or 10% withholding tax is applicable. And in respect of other income or outbound payments from Estonia, there is no withholding tax if we speak about payments to corporate entities. And in Estonia, we don't have capital gains exemption. So if you're parent company of US entity, then Estonian company is not getting any tax exemption if shares of subsidiary are sold. So this was a quick overview from Estonian side. I hope that the slide is helpful if you need to quickly check what possible taxes are due in Estonia. And with this, we conclude this tax part. We are now continuing our webinar, Scaling to the US, How to Succeed. And the second part covers 2 experience stories. And we are glad to listen to Kristjan Kõrgma, who is a senior financial controller in Veriff, and also Alvar Soosaar, who is director of US investment and trade at the Estonian Ministry of Foreign Affairs. And I'm sure that they can give you some good insights how to do the business in the US and how to be successful there. Christian, please, floor is yours.
So hi everyone, I'm Christian. As Ran already mentioned, I'm the Senior Financial Controller here at Veriff, which means I've been responsible for taxes and controlling for about a year now. So perhaps to start off with a bit of background then, and a small disclaimer. So as many of you might already know about Veriff, we provide identity verification services, which basically means that you take a photo of your ID, you take a photo of yourself, and we verify that the two photos match and it's the same person. So there's no physical products, and we offer software as a service. However, what might be sort of less commonly known to people, but still relevant, is that our parent company, our group parent company, is actually incorporated in Delaware, and we have over 30 US employees by now. So in terms of Estonian companies, quite a sizable US presence already. So most of what I'm about to say is related to Veriff specifically, so please don't take it as any sort of like tax and legal advice pertaining to you. But that being said, I am a finance person by trade, so most of what I will talk about will be related to reporting and taxes. But maybe just to start off, what might be most interesting to people and why most of the people might be here is that the actual doing business part in the US, so which I'll assume for most people is looking to do sales in America rather than just hiring talent or building up production facilities. So when talking about sales, I think the biggest learning experience for us has been that you actually need boots on the ground in the US if you want to do sales. It's very hard without having local people. It's maybe possible if you're there yourself locally, but I'd have to say the sales culture in the US is a bit different. American salespeople seem a lot more aggressive, and they have a different style. I mean, we all know the joke about the Estonian salesperson who comes to work in the morning and starts waiting for the calls, right? And there are other cultural differences as well, some of which pertain to culture inside the company, and some of which relate to sales. So, for example, if we look at sort of employment, then often in the US, you can fire people on the spot. People will have a notice period of about, I don't know, 2 weeks before they leave. So it's a much more flexible market than in most of Europe, where notice periods can be up to 3 months before you can actually hire someone new. However, this also means that employees are looking for extra security, which the employer then sort of is being asked to provide. So in some cases, employees will say that, okay, I've been working here for 5 years. Can you pay me for another year, even after I'm not working with the company anymore? So it's a very different environment, and the legal culture is different as well. So it's based a lot on case law, and the way the legal system works is that the truth comes out by suing people. And I've heard this rule of thumb so far that you get a legal case for every 500 employees that you have. So it's a bit different than what we're used to here in Estonia. Is that in Estonia you have to do really something wrong usually to get people to sue you, but in America it's a lot more common, and the financial ramifications are much bigger than they would be here. And I thought this was a very interesting example that we recently enacted sort of harassment training here at Veriff, not because we had any issues with it, but that's sort of something that every responsible company which is operating in the US does. So there are quite significant cultural differences there as well. And in terms of doing business, what is also very important is sort of the time differences. So time difference between the West Coast and Estonia is actually quite steep. So I often find myself having to work between 6 and 10 p.m. and those are already the more convenient hours. So there's almost no matching like 9 to 5 work times between the two time zones. So all in all, in regards to doing business, I would say that definitely have local presence, ideally local people, but if not, then just send someone from Estonia. That you, in my view at least, you definitely need people on the ground. Then in terms of going to the US, then when someone says they're going to the US, they sort of even see it a bit similar as someone says, I'm going to Europe. So when you look at the US, it looks like, okay, it's one country. How hard can it be? But it's actually 50 different states. It's a huge area, both in terms of population and geographical size. And all of the 50 states have their own little rules that you need to follow. So each state will have their own registrations that you need to do. They will have their own sort of labor protection things, which you might need to follow. They will have their own taxes, their own tax rates. They will have their own data privacy laws, et cetera, et cetera. So when you take all of that into consideration, what you should definitely be on the lookout for is that you don't hire people very haphazardly. So when you hire someone, try to keep it in one state or a few states if possible, because the worst scenario is that you have one person in every state, so the overhead gets very, very large very, very, very quickly. And there's actually you can't be helped with everything. So some of the stuff you need to do on your own. So in the US and elsewhere in Europe, you have these things called professional employer organizations or PEOs. And it came as a very large surprise to me recently that actually the states, not all of the states, allowed these organizations to do all the registrations for you. So they're sort of banned or barred from doing so, and you actually have to complete the registrations yourself. And then in terms of the impacts of having a new employee, I'm sure this was covered in the previous session, but if you hire a new employee somewhere, it might mean you start have to collecting sales tax there. It might mean that you are now liable for apportioning some of your income in terms of corporate income tax there, if you are corporate income tax liable, et cetera, et cetera. And I've even heard, I'm not 100% sure this is true, but this is told to me by an auditor in the US that apportion basically means that you need to divide your income across various states where you operate, and it's possible that you need to apportion more than 100% of your income across all the states. So all of the tax laws are quite interesting there. Thirdly, in terms of reporting, you should be prepared that Americans want to know a lot of things about your business, especially the IRS. So the corporate income tax return can be very, very lengthy. So it can easily be 100 pages. Ours was, I think, even a bit longer last year. So customers will ask you for your taxpayer information as a supplier, and so should you, by the way, if you're using independent contractors. So you're expected to sort of gather everyone's tax identification number. They don't have this wonderful äriregistrisystem as they do in Estonia. So each supplier has to sort of send their information to you personally, and then afterwards you remit that to the IRS. And what else? Then each state might have their own sort of little requirements that you need to report on. The best example I had recently was that the state of New York asked us to provide reporting on any unclaimed funds that we have. So any deposits or any checks that suppliers or customers or whoever might have left to us. So I guess each state has their own separate requirements, and that's why I said the worst case scenario is to have one employee in each state, because then you have like 50 states coming after you with requests like this. So the overhead adds up quite quickly. And the sort of last biggest topic I'd like to touch upon is options. So I assume many people in the audience are quite or related startups and quite keen on handing out options. Those are a huge can of complicated worms in America, and you should try to have it figured out before you start hiring. So do some research in advance and make sure that everything is under control. So as mentioned earlier when I started, is that our parent company is in the US, so we're granting stock of the US company. So not all of this may necessarily be relevant to everyone, but I'll just describe what sort of the complications have been when doing it in the US in our case. So we had one example where we wanted to buy back some shares from an ex-employee. And that process took well over a month, and running back and forth between legal advisors, tax advisors, our payroll provider, to figure out all the nitty-gritty and how are you supposed to report it? What are the tax treatments? Do you need to withhold anything? Based on what do you need to withhold tax? What will be the sort of tax return implications for the employee, et cetera, et cetera. So, and one of the amazing things I found out is that when you have a payroll provider in the US, then I guess it's a legal requirement that they can't actually give you tax advice. So in Estonia, you're used to like, okay, I will go to my payroll provider and they will figure it out. That's not how it works in the US. So you need to go to your tax advisor, figure it out, and then give that information to your payroll provider, who will basically only do as you say, and they will not help you too much on that. Yeah, they would like to. They're very, very helpful, but they just can't. So second of all, when you're actually granting stock, then there are a couple of requirements you need to follow to make sure that it's tax efficient. So mainly talking about here incentive stock options, or ISOs. So you need to follow a very specific set of guidelines when you draft the contract, making sure that you don't give the stock to the employee too soon after you have signed the agreement, which is similar to Estonia. However, they also cannot sell it very quickly after they have received the shares, which there's no similar sort of parallel in Estonia. And then there are all sorts of like limitations on how long the contracts can be valid and so forth and so forth. So make sure that you look at that beforehand when you grant stock options in the US. And one also quite expensive thing that you need to do is that when you're giving out ISOs in the US, then you need to do it at market value. And in order to do that, then you need to make sure the strike price has been validated by independent third party. So someone will do the valuation for you, and you can use that as a basis for the strike price in the options contracts. And as you can imagine, that service is not extremely cheap, and you need to do it at minimum every year or after every financing round that you have. So the cost can add up quite quickly. And then the third one is that if you would happen to have a financing round and you would like to do some secondary sales or provide the option for secondary sales to your employees who have vested options already, then you can do it. You can only do it to less than 10 people. So if it's 10 people or more, then you actually need to register a prospectus with the SEC and make sure that you're following all the guidelines and you're providing all the information. So it gets very technical and very complex very, very quickly. And of course, all of this wonderful advice comes at a pretty premium cost according to US hourly rates, so it's definitely expensive. So sort of to wrap it up is that I guess when you think of all the things I've discussed, it can seem like doing business in the US is a huge pain. That is partially true, and you also have to consider the fact that it's also a huge opportunity. So a lot of our business is in the US. And how should I put this? In the US, it's sort of like, I think the biggest difficulty in the US is it's hard to know what you don't know. So the system is so foreign, and it's very hard to sort of know what you have to do. And I think what we've learned is making mistakes along the way is part of the process. Some of those mistakes will be somewhat costly, hopefully not overly costly, but that's sort of the price you have to pay for entering the game, so to speak. So the commercial opportunities are huge, and it can be very, very lucrative despite the sort of startup costs and all the advisor fees that you need to pay in the beginning. So assuming that you have a good product market fit, then it's definitely something you should be seriously considering. And oh yeah, and one other thing I just remembered is that I wish I would have known this before. So when you register your company in Delaware, if you're so inclined, I suggest you do some cap table modeling, especially if it's the parent company, because they tax you on the amount of outstanding shares that you have. So it's a very good idea not to let that amount of shares get too large. But that's about it from my side. Thank you.
Thank you, Christian. And Oliver, please tell us about your experiences and views.
I think Christian had some excellent points. I mean, truly covered many things. And I think one of the things for me that, well, it reminded me that I need to look into a couple of tax things that for my own entities. So thank you. You know, the big thing is there's a lot to figure out. There's a lot to know. And there are people who specialize in this. And you should rely on them. I mean, lawyers and accountants and the rest. At the same time, you're a startup frequently, and you can't spend, you know, major amounts of your very hard-earned round on overhead, on administrative overhead. So you need to sort of figure that balance out. The points about having an employee in each state makes a lot of sense. The way you can sort of think about the United States is regionally, and you know, it's not quite as simple as, you know, East Coast and West Coast. It's sort of, you know, LA area, San Francisco area, Seattle area, maybe on the West Coast, and on the East Coast it's New England, maybe with New York, and then Mid-Atlantic, and then sort of the South and Florida, and in the middle, Chicago area, Midwest, and Texas. But why would you choose those places is very, very dependent on your company. So do you choose a place where the laws are beneficial to foreign companies? No. You choose the place where you're, for one of two reasons. Where are your clients or potential clients, your target market? And where are your investors, your capital providers? And the reason for the first, I think, is quite obvious. With the second, it's the closer you are to your investors, particularly if you're talking about like venture capital, the more you can plug into their networks. So that's sort of the third reason you want to be in a specific place, is the local network. In some locations, for an Estonian company, that can be the Estonian community. That's less of an opportunity than it once was, I would say. There are a few Estonian investors, you know, the names you all know, but generally speaking, you should be focused on how can I hire or bring over someone to do these things myself. And you know, the structuring that the EY folks in London were talking about is very important. How, you know, are you going to have a U.S. entity or you know, an agency sort of thing where, you know, I'm not, that was covered well in the first section, but you need to think that stuff through. Once you decide you need that presence in the U.S., however, then all sorts of other stuff come into effect. I think someone mentioned bank accounts. Maybe Christian mentioned bank accounts. it's super hard to get a bank account for an Estonian entity. I know there's an Estonian company with a US subsidiary here. Almost all of their, certainly all of their senior management are in the US and they're US citizens. And they have had a really tough time trying to open a simple checking account, which checking account is probably something that's a little weird to Estonians. When was the last time anyone in Eesti wrote a check? Not the receipt you get at the restaurant, an actual, essentially bank check. I mean, probably some of the younger folks here never have. And you know, maybe Ranno is about my age and remembers one or two of those, but even there, it's very rare. Then the other thing to think about is, you know, other things like office space. So New York, San Francisco, very expensive locales. Boston's quite expensive as well. Seattle. But you can get access to each of those markets by being nearby within a train ride, let's say. So for New York, you can be somewhere in New England or in Pennsylvania, New Jersey. For the Boston area, you could be in Providence, Rhode Island. In Seattle, you know, you could conceivably be in you know, Redmond, sorry, or any of the other sort of towns around it. It's going to be expensive, but there are ways to make it work. Bottom line is, you know, you've got to think about what your primary markets are, and then are there secondary markets you can either base yourself in to access those, or that can serve as a good place to build up a little bit of traction and then come into the primary market. Otherwise, it's really easy to come here, spend a whole lot of money, and fail. And I know one of the dictums around a startup is do everything quickly. Yes, but jumping here needs to be thought through. So once you've done your research, then you can move quickly. But you shouldn't just come here and do, and then realize, oh shoot, I need to back up, redo everything, maybe deal with this lawsuit because someone sued me, as Christian brought up, and then restart. So generally, I think Estonian startups have been quite good about that, and larger companies, with a couple of exceptions, pretty good about that as well. You know, bottom line is, we at Välisministeerium, as well as at EAS, are here to help as much as we can. We can't provide, you know, legal and tax and human resources advice, but we can help you find, you know, talk through some of the locations. We can there are experts locally that we can at least refer you to. And we're here to help as much as we can. You know, that for us, we are here to help Estonia bring dollars into Eesti, and that can take all sorts of different you know, approaches or different sort of styles. And you know, one can be investment, one can be just tax revenue or sales revenue, which turns into tax revenue. Any of those things can are things we will help you with. So as much as we're able to. So to that end, I'm very happy to you know, make myself available to anyone who's on the, or who is watching this after the presentation, and you know, just let me know. And if our hosts can send around my contact information, I'm very comfortable with that. That's about it for me.
Thank you, Oliver. It was really good to hear, and definitely we will share the context as well. So thank you for coming, and thank you for sharing your experience. So wishing everybody nice evening and all the best for the business in US.
And good morning.
All right, thank
Good
you.
morning then.
All right, take care, everybody.
Thank you. Bye
Bye.
bye.
Bye-bye.